afternoon, friends. In the lecture series on retirement planning, in this lecture I'll be talking about different investment options, and I've tried to analyze that what percentage of return or the interest do these different saving options provide to an investor, and what is the lock-in period of that investment, and from tax point of view, that which scheme is more beneficial, or from the point of view of return, from the point of view of the liquidity, from the point of view of the transparency, from the point of view of the cost. Means there are different parameters on the basis of which we analyze. These parameters I discussed in my previous lectures, that is return, safety, flexibility, liquidity, cost, transparency, ease of investment, and taxability of income. So on the basis of these parameters, these almost 8 parameters, we have analyzed the different investment options, and then we have tried to rank these. So out of these different investment options, 4 investment options I discussed in my previous lectures, that is in my immediate previous lecture, that is NPS, National Pension Scheme, ULIPs, Unit Linked Insurance Plans, Equity Linked Saving Schemes, and Senior Citizen Saving Schemes. I'll be also talking in detail about these different schemes in my next lectures, right? But at this point of time, I'm analyzing the different investment options and making you a presentation, means telling you that how much return they have given in the past 5 years, and what is the lock-in period, and what is the ranking on the basis of those 8 parameters which I've just narrated. That is return, safety, liquidity, transparency, these parameters. So the next is 4 we have already discussed, retirement funds. There are various retirement funds offered by different companies, means mutual fund houses, and these retirement funds, I'm not going into detail of these, I'm just telling you that these retirement funds have given 7 to 12% return in the past 3 years, right? So if you analyze the various retirement funds that are available, these retirement funds mostly invest in the equity market and the debt market. And out of these retirement funds, there are various different options that are available to an investor. That is, whether you want to purely invest in equity, or you want to invest purely in the debt, or you want to make an investment in both equity and debt. So depending on your risk profile, depending on your choice, that whether you are more risk prone person, if you want to get more, you are ready to take more risk but for a higher return, obviously you will go for more equity plans. But if you are risk not seeker but rather the risk avoider, then you will prefer a debt plan, right? Don't misunderstand that in the debt plans the value of the investment doesn't fluctuate. It does fluctuate, but comparatively less as compared to equity. So there are different retirement funds that are available for which you can making retirement planning. So the average return of the past 3 years of different plans, depending on the scheme which you have chosen, is 7 to 12%. And the lock-in period, if you opt for a retirement fund, the lock-in period is 5 years. That is the minimum period for which you make the investment is 5 years. But friends, at the time of the making retirement planning, any fund which you choose, retirement fund, your horizon should be 10 to 15 years, right? Because if you are choosing especially a equity scheme, then equity is volatile. The nature of the equity market is it is volatile, it fluctuates. So over a period of time, it gives better return as compared to other asset classes. So your time horizon should be longer. But anyway, the retirement fund, if the minimum lock-in period is concerned, when I'm saying minimum means you can't withdraw before that period. So that is 5 years. Because if you want to get benefit of tax, because these schemes which you are talking of, these are from tax point of view also, that to what extent they provide the tax benefit. And keeping in mind the tax benefit, these schemes have been analyzed. Because under all these schemes which we are discussing, up to 1.5 lakh rupees, the investment is deductible from your total income for the purpose of calculating taxable liability, right? So almost if I invest 1.5 lakh rupees and if I am in the 30% tax bracket, I'll be saving around 47,000 rupees because 30% tax plus surcharge. So almost it comes to be 47,000 rupees. So outrightly I'm making a saving of 47. I'm reducing my tax liability to the extent of 47,000 rupees, which is a reasonably good amount, right? So these are all these investments which we are talking, they are beneficial from the tax point of view. The next is PPF, Public Provident Fund. Friends, this is very, very popular among the masses of this country. Not only the salaried class, but even non-salaried, self-employed people, business class people. I mean, a very large section of the people who wants to make safe investment. PPF is considered as a very, very safe investment for future. Means for your retirement planning, for your future investment. Suppose if at this stage of my life I am earning, right? I am in the working age group. After my retirement or after 15 years down the line, I want that there should be a good corpus of funds. So at the start of your job, and I will advise you as a student that you must open an PPF account. Even if you can deposit 500 rupees per annum, that is good enough. Means up to 500 rupees, from 500 rupees to 1.5 lakh rupees. That is a maximum ceiling. That is maximally you can invest in a particular year under the PPF is, I'm talking from the tax point of view, is 1.5 lakh rupees, right? So you can deposit up to 1.5 lakh rupees and think that after 15 years, and this 15 years means if you are age of 25 years, you open, or if you are 20 years, you open a PPF account. In the age of 35 years, you will be having good corpus of fund if you deposit 1.5 lakh rupees every year. And then after 15 years means in the age of 35, you start at 20, in the age of 35, you extend it for another 5 years, which can be further extended for 5 years, means it is extendable 5 years. So as you will become older, you will find a good corpus of fund is being deposited, and since it is having a sovereign government guarantee, so it is a very, very considered to be very safe investment, and which gives normally a higher rate of interest as compared to the other bank fixed deposit and other saving options. At present, this is very competitive rate as compared to if you ask about the senior citizen saving scheme, which is giving 8% return. But this PPF, because senior citizen saving scheme is available only for senior citizens, 60 years and plus. But this PPF can be opened by any individual, any resident Indian, any individual. So here the rate of interest is 7.1% from January 23rd. Means the latest rate of interest is 7.1%. This rate of interest on PPF also keeps on varying, but the variation is not very high. It's a very minimal type. At present, the rate of interest on the PPF amount is 7.1%. But the lock-in is for 15 years from inception. When you open a PPF account, your fund will be locked in for 15 years. So friends, those people who want to make future investments for their retirement planning, PPF is a good, very safe investment, because if you invest in any equity related funds or debt funds, there the investment amount fluctuates, but here you get a fixed sum of money with a reasonably good rate of interest. So PPF, and it is very tax friendly investment, means not only at the time of investment, that is each year 1.5 lakh rupees is deductible from your total income for taxable liability, but even when you withdraw the money, after 15 years you withdraw the money. So whatever the interest that is accrued during these 15 years, and even in the life of your investment period, that is during those 15 years, the interest that is being earned on PPF, that is exempted from tax. So there are at 3 points of time there is a tax benefit at the time of investment, plus the interest earned on this PPF, plus when you withdraw the money, at the time of withdrawal also there is a tax benefit. So there is a triple benefit when you invest through PPF. That's why it is a very, very popular form of investment for it. But the only thing is that it is an investment for a long period of time. And the return, as I have said, return means since the rate of interest is fixed, so the latest rate of interest is 7.1%. The other saving options from tax point of view can be the pension plans. Like the retirement funds, there are different pension plans that are available. So these pension plans, again, both the government sector organization as well as the means public sector organization as well as the private sector offers the various pension plans under various schemes. There are a whole host of schemes. I'm not discussing those schemes. I'm just referring it. So they also gives you 7 to 8%. In the last 5 years, the average return is 7 to 8%. These pension plans mix not only investment in equity but also in the debt, the money market instruments, treasury bills, because they want to make such investment which are very, very safe, because people's money is involved and people buy these pension plans for their future, means at the time of retirement or when they were not able to earn, means business class people. If you feel that at the age of 60 or 65 you are not able to do your independent business, at that point of time you must have a regular stream of income. For earning that regular stream of income, you are buying a pension plan. So the fund managers who are investing your money, they will invest in a manner so that the amount that is they are investing, it is also very safe investment. Right? The level of fluctuation is less, so that they can give the assured money, assured annuity to the investors, those who have invested. Right? In the pension plans also, the investment is up to the period of retirement. Then you have a very popular fixed rate of interest option that is called National Savings Certificate. You can buy NSCs through post office, tax saving FDs. Right? These days, Government of India, if you make deposit for 5 years in any public sector bank or any bank, then it is deductible under your income. 1.5 lakh rupees of investment is deductible from your total income under Section 80C. And the present rate of interest, if you go by the January 2023 figure, the rate of interest varies from 7 to 7.5%. Right? So depending on your age, depending on the investment which you are making in a bank you are making, so these saving FDs give you a return of 7 to 7.5%, and even on the National Savings Certificate also the return is 7%. But the lock-in period is 5 years. In the NSC it is even higher. This 5-year period is for tax saving fixed deposits. And then you have a insurance planning. When I was talking about the ULIP, unit insurance plans, at that point of time I was saying that under the ULIPs, unit linked insurance plans, you have a twin benefit of investment, means your insurance, your life is assured, plus investment in equity and debt market. But these insurance policies are being purchased or investment is being made purely for your, what you call safety purposes. That if anything happens to the person who is making the insurance, or you are buying an insurance policy for your child, for your spouse, right? If something happens to that person, in that case, the insurance, during the tenure of the insurance policy, the insurance company will give a fixed sum of money, right? And if nothing happens at the expiry of the policy. But the rate of return in the insurance policies, because I would not say it is a great investment option. It is not considered from the investment point of view, is more of the safety point of view. So these insurance policies gives lesser rate of return as compared to these other saving options, which investment options which we have discussed. Like you can see this, the rate of return in the insurance policy during the last 5 years, if you take the average return, is 5 to 6%. On the other hand, tax saving FDs give you 7.5%, this pension plans give 7-8%, PPF gives 7.1%, retirement funds give 7 to 12%, senior citizen schemes gives 8%, ELSS give 9.65%, ULIPs 8 to 9%, NNPS 8 to 11%. What it means is the insurance gives the least return as far as the return is concerned. But friends, you should be very clear, when you are buying pure insurance policy, it is not merely from investment point of view, but it is all basically from the safety point of view. And as a financial advisor for your retirement planning, you must buy. Very first thing which we advise, or I would say you as a financial planner should advise to the people whosoever comes to you, that first thing you should do is you buy the insurance policy, right? So that if anything happens to you, your dependent persons, your spouse, your children, at least they are, to some extent, they are financially secure. That is, at the time of the death of the person, the nominees will get a fixed sum of the insurance policy amount, right? So that way they can have some livelihood of their life, right? But these insurance policies, normally these are lock-in period is of minimum 5 years. So friends, these are the 9 different investment options which we have compared, and we have compared on the basis of these parameters which we have already discussed, right? And this is on the ranking has been made on the basis of different parameters. And at present, if I talk of the 2023, the beginning of the 2023, since it is expected that equity market in the coming year rather, will be fluctuating, the return is, it is all expectation, is comparatively lesser. So means it will be fluctuating market. So the investment in the debt market can give a better return, or I will say a reasonably good return. Normally equity market gives better return than the debt market. But since it is expected that in the year 2023, that equity market will be quite fluctuating, so it is expected that debt market can also give good return. It will be comparable to equity market. That's why, because under the national pension schemes, people can opt for different options. Either you can opt in a scheme which provides equity investment or purely debt investment plus equity plus debt, depending on the scheme which you choose. But maximally investment that is made in any national pension scheme is 75%, right? So it is expected that for the current year, given the scenario, given the economic scenario world over, this national pension scheme is a good option, keeping in mind all these 8-9 parameters which I have talked about the safety, return, liquidity, transparency, and all those parameters. If we analyze those parameters, NPS, ULIPs, equity-linked saving schemes, senior citizen schemes comes to be on merit for investment purposes. This is, as a financial advisor, as a student of finance, as a student of personal financial planning, you can compare these schemes and you can advise to the people that these are the different investment options that are available, which are tax friendly, which saves tax also, and which gives good returns. So after talking of this, let me talk briefly about some of the schemes in little bit more detail. Like when you are talking of retirement planning, the moment a person retires, presumably at the age of 60. Normally in India, people retire in the age of 60. In some of the corporate, especially in the private sector, do retire its employees in the age of 58 also. But normal, if you take by and large people in India, if I talk in Indian context, they retire in the age of 60. So up till that age, you have a regular flow of income. But when you attain the age of 60 years, you want that whatever you have earned, whatever savings you have made, right? So that saving should be invested in a manner which is safe, plus gives you good return also, right? And which is also tax friendly. Keeping this in mind, the Government of India has started this senior citizen saving scheme. And especially if you talk of for the last 3-4 years, for the last 1 or 2 years, 1 year rather, I would say, from 2021-22, the rate of interest in India and the world over have started rising. But before that, the rate of interest were quite low. Means they were as low even on bank FD. If you talk of either 2020-19, they were as low as 4 to 5%, 5% on bank fixed deposits, which most of the senior citizens do deposit their large sum of their savings in the bank fixed deposit. So at that point of time, in order to provide relief to the senior citizens, the Government of India started this senior citizen saving schemes. That is, various banks of this country, right, started a scheme of named senior citizen scheme, in which they offered a higher rate of interest as compared to the bank FD. And at present, from January 2023, this rate of interest at present on the senior citizen savings scheme is of 8%. But the period for which the fixed deposit will be made will be 5 years. But all individuals cannot make this, can deposit their money under this scheme. Only the people who have attained the age of 60, right, can deposit their money. So, senior citizen savings scheme is a government-backed saving instrument offered to individual aged over 60 years. The maturity period is 5 years, as I've just talked about, right. However, the tenure can be extended by 3 more years after the maturity period of 5 years is over. Current interest rate is 8%, I've already explained, payable quarterly on first working day of April, July, October and January. So, rate of interest, if you want a regular flow of income, so you can get the interest also. So, what are the benefits of the scheme? Tax benefit up to 1.5 lakh rupees which you deposit is deductible from your total income. Safe to invest, very easy, in any post, in any bank you can deposit this money. Premature withdrawal is allowed, but it is subject to some deduction. Suppose I make the deposit today and after 1 year I want to withdraw the money, right? Supposing there is any emergency and I need the money. In that case, some penalty, although the penalty is very small, 0.1% like that. So, penalty will be charged, but premature withdrawal is allowed. In the first year you can't withdraw. After the first year you can withdraw the money, but with some penalty. After 2 years if you withdraw, that is the penalty becomes lesser, but the rate of interest which the bank will offer will also, there will be penalty on the rate of interest. Suppose I deposit the money in a senior citizen savings scheme at the rate of 8%. After, in the second year of the, or after second year I want to withdraw it. So, I will not be offered 8%. A penalty means rate of interest will be deducted, say for example 7%. So, I will be given 7% rate of interest. But anyway, there is a facility that you can withdraw the money if there is an emergency, you want to withdraw it. The other benefit can be, the account can be transferred across the country. So, if you move any part of the country, you just information to the bank, the other part of the country, the money will be transferred. Means the account will be transferred. And interest rate is obviously 8% rate of interest is a reasonably high rate of interest, keeping in mind the safety of the funds and keeping in mind the sovereign guarantee. It is a government backed scheme. So, since it is a government backed interest, it enjoys the highest security, right. So, this is on this amount of safety, if you are getting 8% interest, it is a I would say inflation beat in rate of interest, because whenever we make any investment, we must see the return which we are getting, whether this return can beat the inflation. On an average in India, the inflation rate is 5 to 6%, I will say 5%. So, if you are getting a 8% interest, it means your real rate of interest is 3%. 8% minus 5%, to put the things simple, right. So, you are earning something, your value of money, you are not losing money, right. So, any investment which you make, you must see that the return which you get on the investment, can this return will beat the inflation, right. So, the wise investment is that which offers a return which can beat the inflation is a I would say first thing as a financial planner you must see. So, this I have already explained. Interest rate is 8%, the investment is 1,000 up to 15 lakh rupees, premature withdrawal is allowed, right. So, who is eligible? 60 years of age, individuals who have attained the age of 55 years old, but are below the age of 60 years old and have retired on superannuation eligible to open, right. Normally, it is of 60 years plus people, but if a person is retired between the age of 55-60 years with this undertaking that the person has got superannuated or was being superannuated by the company, in that case you are eligible to open the account. Non-resident Indians are not eligible to open the senior citizen savings schemes. This scheme is basically available for Indian citizens. See, why it is available only for the Indian citizens? Because as I said, when this scheme was introduced, senior citizen savings scheme, at that point of time, the rate of interest in India, especially in the banks, were quite low, around 5%, right. So, if the savings of the senior citizen is being invested at a 5% or 4.5% or 5% rate of interest, in that case, the regular flow of income, the people who live on the interest income of their savings, they find it difficult to have their livelihood of this small interest income. So, keeping that in mind, the senior citizen savings scheme was being introduced in the country. So, this was basically to provide benefit to the Indian residents, right, especially the senior citizen. Similarly, HUFs are not eligible to open senior citizen savings scheme as well. So, if you analyze these schemes, you will find that these schemes, this scheme, that is senior citizen savings scheme, is primarily for the senior citizens, which offers a higher rate of interest as compared to the bank FD, which is 100% safe, and plus there is a tax benefit also, right? So, in the senior citizen savings scheme, the interest which you earn, up to 50,000 rupees interest which you earn is not taxable. That if you deposit your money in a citizen saving in and you get an interest income, I am presuming that there is no other FD you have made. So, up to 6.5 lakh rupees almost comes to be that if you invest up to 6.5 lakh rupees, the maximum ceiling is, friends, 15 lakh rupees. But because in 15 lakh rupees of investment at 8% rate of interest, your rate of interest comes to be 1 lakh 80 plus 40, right? 1 lakh 20,000. So, exempted tax is 50,000 rupees. So, if you invest if I make the calculation, approximately 6.25 lakh rupees if you invest in a citizen scheme and you earn interest of 50,000 rupees on 6.25 lakh rupees, in that case, whatever the interest income you earn, it is also not taxable. It will not be included in your income. It is tax, means your tax total income, the interest plus interest, when you are being taxed, you are taxed on a total income. But up to the 50,000 rupees interest which you have earned, it will be not taxable. So, it is a big relief from tax point of view also. So, this is about senior citizen saving schemes. That is a good scheme, people get benefit out of it, but by and large, this scheme is being enjoyed by senior citizens, especially their small savings, their retirement, at the time of retirement, they want to park their money in a safe investment which gives them a regular income. And since the quarterly interest is being paid, so that way you can get the interest on a quarterly basis also. So, this is about a little bit of detailed discussion about senior citizens saving schemes, and in the beginning of this lecture I have talked about various schemes. That is, in the previous lecture and this lecture we have talked about 8-9 different investment options, right? These were the investment options which we talked: NPS, ULIPs, equity linked saving schemes, senior citizen saving schemes, retirement funds, PPF, pension plans, national saving certificates, tax saving FDs, insurance policies, right? So, these were analyzed on the basis of these parameters, right? So, why these are investment options are good, because they are good not only from tax point of view, but they are also good for your retirement planning, because whatever investment we are making today, we are making an investment keeping in mind that in future when you will need the money, we will have a regular flow of income. Thank you very much, friends.